It is now my privilege and distinct honor to announce this year's presidential address and provide a few sentences of introduction to our speaker, AFA President Monika Piazzesi. Monika is currently the John Kenny Professor of Economics at Stanford University and also a professor by courtesy at the GSB. In addition, she's NBR Research Associate, CEPA Senior Fellow, CEPR Research Fellow, and of course, she has been the fearless leader of the American Finance Association over the past year. Now, the way these introductions go, they sometimes tend to be somewhat of a light roast of the outgoing president, but I do have to confess that this is going to be a little bit hard for me. Those of you who are not German, and the German accent bubble up here seems to start deflating with this year, well, those of you may not know that I've basically been in Monika Piazzesi fangirl position for the past 25 years. I vividly remember starting as an undergraduate student, starting my degree at the University of Bonn, and other students explaining to me who the cool kids are over here, those who managed to get one of the coveted exchange program spots with either UC Berkeley or, if you're really good at math and really smart, hanging out at the NSO in Paris for a year. Needless to say that Monika was part of that crowd. I certainly knew who she was, but I don't think I ever got noticed. You can then imagine my excitement when it was time to apply for PhD programs and later to visit schools for various admit days. And I got a personal email from the Monika Piazzesi, then a grad student at Stanford, encouraging me to meet up and consider Stanford. And the pattern kept repeating. Wherever I went, Monika was already there, on the job market, at various NBR programs, and finally here in the AFA leadership. Needless to say that I'm anxiously watching what her next steps are and hope we can have a talk. Now, in fairness, there are some aspects where the parallels end. As much as I would like to, I don't think I will be able to copy Monika's unique way to deal with, for example, board meetings that don't quite go the way or quite go at the speed they were intended. Friendly face, ever so slightly puzzled frown, and look that makes it clear that you're going off the rails and you better don't stay there. The parallels also end when we consider what Monika has achieved academically. From the get-go, out of grad school, she has been one of the most impactful researchers in the areas of asset pricing, bond pricing, macrofinance more broadly, and in recent years, several seminal papers in the area of housing. What I deeply admire about her work and think is worth highlighting here, in particular, two things. First, Monika might be a very classically trained macro asset pricer, one of the many outstanding Sargent, Duffy, Singleton students Stanford has produced. But that did not make her dogmatic. Even as a behavioral economist, I have so appreciated her broad interest and openness to alternative approaches, just as long as it's good economics, interesting data, interesting question. I can attest, as some of the co-directors now running the NBR Behavioral Macro Program, that her participation and engagement early on has been really crucial to establishing that program. Second, whatever Monika has been thinking about and writing about, if you read the paper, if you read the output, you can be sure to learn something deep, a deep insight that she conveys in the paper. It won't just be the got new data, got fancy metrics, no cool theory you don't know cocktail, which sure can get you published. There's something in her papers, there's always something I feel she has wrestled with. Something she might be unhappy about in the existing literature, among the existing interpretations, and something she is now challenging. Despite her prolific research output, I'm sure she could have pumped up the volume even more had gone for the quick win, the sexy add-on to existing research. And I so appreciate that this is not the trade-off she would make, that every paper is truly worth the read. As for tonight, I cannot wait to hear what she will tell us about housing betas. Madam President, the floor is yours.
Thanks so much, Ulrike, for these really, really kind words. Thanks, everyone, for being here. The year putting together the program for the AFA last year and this entire year being a president gave me a new appreciation for our fields, for the innovative work that especially young people are doing on brand new topics like climate change, AI, and polarization. We are an amazing field, and thank you for being part of it and for contributing to this amazing ride. So today I'm going to talk about three broad classes of assets: stocks, housing, and bonds. Finance usually studies housing in isolation in a separate literature, and that makes sense because there's market segmentation. The top 10% of the wealth distribution holds most stocks, while the middle class buys most houses. Today I'm going to argue that it's important to study these broad asset classes jointly. The reason is that credit markets connect these otherwise segmented markets and thereby create spillovers. What I'm going to show you today are some new stylized facts about the cash flows and the returns on these assets, together with a model that illustrates some candidate mechanisms that might explain these facts. But much more future work will be needed to quantitatively assess these mechanisms. So let's take a first look at the data. I here compare annual data on real returns over long horizons. So these are 10-year holding periods. I measure stock returns using prices and dividends on the S&P 500 from Bob Shiller's website. I measure housing returns using the value of US residential housing from the financial accounts. These are the former flow funds. And when I compute capital gains, I subtract off gross investments, because that's a measure of new housing. That's also in the financial accounts. The data goes back to 1945. To measure housing dividends, I use rent expenditures, which include imputed rents for owner-occupied housing from the NEPA tables that go back to 1929. These are all nominal returns, and so I subtract inflation to get real returns using the price index for non-durable goods and services from the NEPA tables. And so let's look at the real return on stocks. So this is post-war data on real returns on stocks. What you see is, for example, low returns in the mid-70s on stocks. Those are returns on stock purchases that were made in the mid-60s. But you see more episodes of declining or low stock returns. For example, the early 2000s when the NASDAQ collapsed, followed by the financial crisis in 2007, and more recently, the COVID pandemic and the post-pandemic inflation. Those are all times when stocks didn't do well. Let's add housing returns to this picture. Housing returns are less volatile, so I measure them on the right axis. And so what you see is that the stock market slump of the mid-70s was actually a house price boom, where housing did really well. In the 60s and 90s, housing returns were low. That's when stock prices were booming. In the early 2000s, while there was a NASDAQ decline, the house market started booming and had a house price boom. And then the two assets collapsed together in the financial crisis. And they also recovered together. And much more recently, over the last 2 years or so, you see, again, sort of negative co-movement. So if you look at this picture, the sample, what you mostly see is negative co-movements in returns on stocks and housing, except after the financial crisis, when you see some strong positive co-movements. I'm going to use these shaded areas to remind ourselves of periods in which housing did particularly well. And so that's going to be a reference point later, in later pictures. I can measure this co-movements by estimating betas, the stock market beta of housing returns. That's what I do in this graph. I estimate beta using a two-sided exponential decay that puts a 10% weight on observations from 5 years ago and also 5 years into the future. So it's two-sided. And so what you see in this picture is mostly a small housing beta or negative up until the financial crisis when you see a positive housing beta. So the sign of the beta has been changing over time and it's been negative over most of the sample and positive more recently. So what are the key differences between stocks and housing so that their returns are negatively co-moving over much of the sample? Somewhat surprisingly, the difference is not in their cash flows. So let's compare 10-year real cash flow growth rates of stocks and housing. That's this picture. And again, I measure the cash flow growth rate of housing on the right axis because it's less volatile. But what you see when you look at this graph is mostly positive, strong positive co-movement in cash flow growth rates on stocks and housing. In fact, when you measure the beta, stock market beta of cash flow growth of housing, you basically mostly get positive betas over this sample. Okay, so what would we expect for assets that have very similar cash flows that co-move strongly? Let's look at a standard benchmark model with two Lucas trees. Aggregate output is exogenous and has an IID growth rate in logs with a normal distribution with some expected value mu and a variance sigma squared. The two Lucas trees pay dividends. They're defined as shares of aggregate output, one share for stocks, another for housing. And I put a single agent in this model with log utility who owns these trees, gets labor income, and consumes aggregate output. In the equilibrium of this model, the returns on the two assets, stocks and housing, co-move positively, not negatively as we saw in the graph. And with log utility, the reason is with log utility, you have constant savings rates and constant price dividend ratios. And so what happens is that returns move with shocks to cash flow growth. And cash flow growth is aggregate output growth in the setup. And so they strongly co-move. There are other forces in conventional asset pricing models that generate time-varying discount rate to value cash flow streams related to consumption, just like the two Lucas trees in this model have. A time-varying discount rate tends to generate positive co-movement in returns, and so that won't help in this setting, and neither does demographics. Okay, so what are the key differences between stocks and housing? The first key difference is liquidity. There are high transaction costs in housing. Some of them are pecuniary costs, commissions to real estate agents and recording and other fees. And some of them are non-pecuniary costs associated with selling a house and moving out of an area. All these costs are low in stocks. As a consequence, houses trade rarely. Only 10% of houses trade every year, while stocks trade often. And that leads to long average holding periods. They declined somewhat over the last decades. So in the American Housing Survey, I measured the average length that a homeowner has stayed in his house, and it's 15.1 years in 1980s, 15.4 years in the year 2000, down to 11.5 years more recently in 2021. And so that's why it makes sense to look at real returns on assets over decade-long holding periods. Another consequence of this illiquidity of housing is that a small group of traders matters for house prices every period. So the vast majority of households don't buy or sell houses, and so they don't matter for the determination of house prices every period. The second key difference in stocks and housing is leverage. And so let's study the small group of buyers every year. The left graph shows you that the blue line is the share of buyers that has a mortgage. And you see the vast majority of buyers do have a mortgage. The green line is the share of first-time buyers among these. And you see that a substantial share, roughly half of them, it's their first time to buy a house. The right graph shows you the share of income that buyers spend on mortgage payments. The share is higher in the housing booms of the 70s and the 2000s. But if you look at the end of the sample, the most recent housing boom, you see that the share of income spent on mortgage payments is lower. So I'm not sure I mentioned, the solid line is the median, and the dotted lines are the top quartile and the bottom quartile of this distribution. And so you see the whole distribution is shifting down during the COVID boom. The reason is that now buyers are older. They're on average 5 years older, and they're richer when they're buying a house, and so they have less of a mortgage when they buy. Since leverage is important for home buyers, how do borrowing costs vary over time? And so it's a well-known stylized fact that mortgage rates strongly co-move with 10-year treasury rates. So let's study the return on 10-year treasury rates from Bob Shiller's website. So here you see the time variation in borrowing costs. Borrowing costs are lower in the housing booms. In fact, they're negative in the housing booms of right after World War II in the mid-70s and also the recent COVID boom. The borrowing cost was not negative in the early 2000s, but borrowing costs were lower than in the previous decade. So you always have lower borrowing costs in housing booms. So then the question is whether this time variation in borrowing costs affect the co-movement of your housing investment with stocks. So let's look at the returns on levered housing. I measure that as housing returns minus borrowing costs, where I multiply the borrowing costs by 80% to reflect the typical down payment. And so here's the return on stocks again. Let me add the return on levered housing. That's the green line. And so what you see here now is even stronger negative co-movement in returns. Now these two theories live on the same axis because the return on levered housing is quite volatile. So they're both measured on the left axis. And you see these strong episodes of negative co-movement until the financial crisis when the two theories start to co-move. And again, very recently over the last years, you see negative co-movement again. If you look at if you estimate the beta for levered housing, it's more negative than the beta for unlevered housing, which is also depicted here. So you see it's more negative, and then it also starts co-moving. It's a positive beta since the financial crisis. The third difference between stocks and housing that is really important is diversification. The Sharpe ratio of the overall stock market captures risk-return trade-offs that households face in the stock market. That's because since the 1970s, households buy passively managed mutual funds and index funds. And so while individual stock investments have substantial idiosyncratic risks, those get diversified away when you buy mutual funds and index funds. For housing, the Sharpe ratio of the overall housing market is not relevant. Households buy a single house that's not a diversified mutual fund or an index. The location of the house matters for the average capital gain on an individual house. So for example, over the last decade, the average capital gain in San Francisco was 7% per year, versus 40 basis points in Huntsville, Alabama. And people like to compare these two cities because they both have a substantial tech sector. But the average capital gains across the two cities are very different. So that allows me to measure the idiosyncratic component of capital gains on individual houses. So I measure capital gains using houses on repeated transactions of the same house, and then I subtract the location-specific average capital gain over the same holding period. And that gives me a cross-sectional distribution of idiosyncratic capital gains that looks like this in San Francisco. So the blue histogram is for transactions before the financial crisis. The red histogram is transactions after the financial crisis. And so what you see is huge dispersion of idiosyncratic capital gains. They range from minus 40% per year to plus 60% per year. So a wide range and strong positive skewness. And since the financial crisis, even more stronger positive skewness. You might think that in Huntsville, Alabama, this graph would look different because the average capital gains look very different, but that's not true. This is the histogram of idiosyncratic capital gains in Huntsville, Alabama, and you see the same large dispersion, and again, stronger positive skewness in this distribution post-financial crisis. Okay, so let me use some of these features, the key differences between stocks and housing, and try to think again about why it is that stocks and houses have returns that are negatively correlated for most of the sample. So we're going to have a model with, again, Lucas trees for stocks and housing, bonds in zero net supply. And what I change now is the agents in this model. So let's have two period-lived overlapping generations with log utility. The agents only consume when they're old, and we have two agent types. There's a mass delta S of stockholders who can trade stocks and bonds, and they get some labor income, which is a fixed fraction of aggregate output. There's also a mass of home buyers that can trade in houses and bonds. They get labor income, which is also a fixed fraction of aggregate output. And that allows me to compute aggregate labor income as the sum of these incomes appropriately weighted. So this is a minimal model with heterogeneity and segmented markets for Lucas trees. The model captures the idea that there's benefits of ownership in housing. That's a popular idea in the housing literature. It says that home buyers receive dividends from their house that other investors simply would not receive when they would be holding the house. And that is an argument that is typically used to explain why so many want to own their house, why the home ownership rate is high. Again, in this minimal model, I have a constant savings rate here because agents consume when they're old, and so what they basically do is take their income and save it. And that's to focus on this negative co-movement between these two assets. Think of agent type H as representing the small group of home buyers that determine house prices every period. We could have a simple extension to a third agent type of this type would be a passive homeowner who is not trading, who is not buying or selling, and who doesn't matter for house prices. I won't do this here. I will just keep these two agent types. Let's study a stationary equilibrium with constant price dividend ratios. Markets here for stocks and housing are segmented, but they're connected through the credit market. And so asset demand is going to be simple. It's going to be the Merton portfolio weight for stocks multiplied by the income of the stockholders. And for housing, it's the Merton portfolio weight for housing multiplied by the income of the home buyers. Market clearing for stocks and housing then equates the demand for these assets to the fixed supply of these Lucas trees. Credit market clearing equates the borrowing and the lending across these two types of households. Okay, so far everything is symmetric. The assets are symmetric, they have the same cash flows, the agents are symmetric. So what might generate gains from trade in the credit market? So proposition 1 gives you a condition under which home buyers will borrow from stockholders. The condition says that if income of home buyers relative to the size of the dividends that they receive is smaller for homeowners than for stockholders, they will borrow from the stockholders. And so this makes sense because leveraged house purchases is also what we see in the data. This is what we saw earlier. Home buyers tend to be poorer relative to the future dividends of their assets than stockholders. And the credit market is the way that allows the home buyers to use the savings of richer stockholders to buy housing. What happens if we add a borrowing constraint? A borrowing constraint puts an upper bound on the housing demand of households. The constraint is tighter when real rates are high. And so housing demand is no longer just the Merton portfolio weight times the income of the home buyers, but it's the minimum of the Merton portfolio weight and some upper bound, which depends on the real rate. And so constrained housing demand is not sensitive to the expected growth rate in this economy or the uncertainty about the growth rate. So what now in this setup can explain negative housing betas? So suppose borrowing constraints bind, then bad news about the economy in the form of lower expected growth or higher uncertainty about growth. It's going to imply a lower price dividend ratio for stocks, a lower real rate, and a higher price dividend ratio for housing. So you see inverse movement in response to bad news about the economy. So this is a credit supply channel. Bad news about the economy leads to more credit supply. The reason is that stock owners, they shift their portfolios away from stocks towards bonds. Stock prices fall and real rates fall. And that allows home buyers to borrow more and push up house prices. So I want to emphasize that this is bad news about the entire economy. It's not just bad news about one of the two assets. And that's important because housing and stocks are two assets with very similar cash flows, and so it would be strange to have news just about one of the two assets. So what are some candidate bad news that we saw over the sample that might generate these negative betas for housing? The great inflation in the 70s introduced a lot of uncertainty about where the economy was going to go. Dot-com companies missing earning expectations in the year 2000 created an update for us for what the internet could do for the economy and lowered growth expectations. The COVID pandemic and the post-pandemic inflation again introduced uncertainty about the economy. So all these forces are things that push towards negative housing betas through more credit supply. I want to Here, the gains from trade in the credit market arise because homeowners are poorer relative to their dividends than stock owners. There are alternative mechanisms that the data also suggests are going on. One is aggregate risk sharing. As I mentioned earlier, cash flow growth of housing is less volatile. It's less exposed to aggregate risk than stocks. In the model, that generates gains from trade. Home buyers would borrow from stockholders who are investing in the riskier asset. A second reason is diversification of idiosyncratic risk. So in the data, we looked at distributions of idiosyncratic risk, and they're substantial. In the model with non-defaultable bonds, as I have it here, that would generate less borrowing by home buyers. But if we extend the model to defaultable bonds, now home buyers can borrow from stock owners, and so they share the idiosyncratic risk in their house with the stock owners who have a diversified portfolio of these defaultable bonds. So quantitatively, the question is, which one is the one that is driving the gains from trade in the credit market? They could all be going on. In a quantitative assessment, you would also think about other ingredients. arguments that were made in the housing literature for example, to explain the housing boom in the early 2000s, such as laxer collateral requirements or optimism among home buyers. These forces in the model with segmented markets would increase housing demand and thereby push up the real rate, so the borrowing costs. That's not what we see in the data. As we saw earlier, borrowing costs tend to be lower during housing booms. And so there must be something else going on, something that shifts credit, that increases credit. And so the literature has thought about various mechanisms that this could happen. For example, reduced lending frictions in the banking sector might lead to more lending by banks to mortgage borrowers, or lender beliefs, or higher government subsidies. These are all forces that lead to more lending in the mortgage market. They're all credit supply shifters. And so the credit supply shifter that I showed you was bad news about the entire economy. And so then you have this shift of stockholders away from stocks towards bonds. Another related literature is things about the switching signs in bond betas. Bond betas were positive before 2001, negative after that, and then again positive after 2021. These papers study bonds and stocks in isolation, and so now it's interesting to think about what are the consequences for housing markets. And in fact, if you flip the sign, because these are the borrowing costs, of homeowners, if you flip the sign of these betas because they are shorting these, they would reinforce the negative housing betas. What explains the fact that since the financial crisis, we now have positive housing betas? Some of these forces are higher savings by home buyers. That leads to less credit. That weakens this credit supply channel. The very stark case is one in which the incomes of the home buyers relative to the dividends that they receive is equal to the income of the stock owners relative to the dividends that they receive. In that case, there's no more credit in this economy. And in that case, bad news about the economy does not affect price-dividend ratios anymore, but still lowers the real rate. What's a force that generates co-movement in the price-dividend ratios? Well, higher overall savings increase price-dividend ratios in this economy. And also, discount rate changes move prices of all risky assets together. And so why would home buyers and stock owners now be richer? And so there's a bunch of candidate explanations. One is demographics. There are older and therefore richer households who now buy stocks and houses. And that's consistent with the earlier facts that I showed you on buyer age going up and incomes going up and purchases happening with less borrowing. Another interesting new feature since the financial crisis is that we have institutional and foreign investors entering the housing market. And so that's new. It's a channel that uses savings of stockholders and puts them towards housing. And so that pushes us towards a representative agent model that generates positive co-movement in the returns. There's already exciting work on these mechanisms, on how demographics affect price-dividend ratios of long-lived assets, on the role of institutional investors and foreign investors in real estate markets. And so these would be the forces that generate a positive housing beta more recently. So let me wrap up. Housing betas are often negative, while stocks and housing have very similar cash flows over long horizons. Housing betas are positive after the financial crisis. And again, over the past few years, we saw again some negative co-movement between the returns on these two assets. A representative agent model can't help us make sense of this negative co-movement because it generates positive co-movements for returns on assets with similar cash flows. And so that's why we need something else. We need to acknowledge that there are other differences in the markets for stocks and housing. And so I showed you a model, a minimal model with segmented markets that are connected through the credit markets with heterogeneous agents. The credit market allows the home buyers to use savings of richer stock owners to buy housing. Bad news about the whole economy then generates negative housing betas because there's a credit supply channel. Stock owners shift away from stocks towards bonds, and that allows home buyers to borrow more and push up the price of housing. So what are forces for positive betas since the financial crisis? Demographics, institutional and foreign investors are forces in that direction because they move us back towards a representative agent model where you have positive co-movement. Thank you very much.
Thank you so much, Monika. Thanks for an excellent presentation, bringing all the strings of your research to some extent, or the themes together. It's now my role to thank you both for the excellent address and your service as the AFA President over the last year and, of course, the years before. And finally, also to include you in the group of our distinguished fellows. So for that, I'm handing now these heavy plaque and fellow award to you. Congratulations.
Thank you very much.
All right, and I think with that, I'm taking over the show, and my first act of business is to invite you all to join the reception. It will be just next door in salon number 8, and we adjourn the meeting. Thank you very much.